Welcome to Growth and Inspire, where we examine topics that make us feel inspired and grow. I'm your host, Bonnie Yam. Today, we will be talking about cash balance plans, a very powerful way to increase the deferrals for retirement. It is a complex instrument, so I'm very glad that I have some experts in the field to assist us to get a better understanding of the product. Our speaker today is Ricky Atamian from October 3. Welcome, Ricky.
Thank you, Bonnie.
Yes, so happy to have you on our podcast. Before we start, can you tell me a little bit about yourself and your company?
Yes. So I've been working, my name is Ricky Atamian. I'm an enrolled actuary. I've been in the retirement industry for a little over 20 years. I currently work for October 3 Consulting, which is a small to mid-size retirement kind of consulting firm that focuses on the administration and actuarial side of mostly cash balance plans and corporate defined benefit plans as well. Our bread and butter is the cash balance, market return cash balance space, usually, again, working with professional service organizations on those.
Thank you. Thank you. A lot of people know about 401k, but not everyone knows about cash balance plans. Can you explain what is a cash balance plan?
Of course. So, it's very similar in nature. It can be, depending on the design of the plan, to a 401k plan. Really, what a cash balance plan does is it provides kind of a tax advantage accumulation strategy, a lot of times for owners and partners, again, of those professional service organizations that I was talking about earlier. What they really do is, like I said, they operate similarly to a 401k in the sense that each year or quarter or month, depending on the design of the plan, the participant earns a credit, a benefit credit, kind of similar to their own deferrals or to like a company match in a 401k or profit sharing environment. And then each year, annually usually or daily, depending on the rate, they also earn an interest credit. So, for example, let's take just Jane Doe. She gets $1,000 benefit credit at the end of year one of a cash balance plan. So usually the credit's earned at the end of the year. So 12/31, she earns $1,000. So at 1/1 of that following year, she has $1,000 in the account. Now let's say that cash balance plan credits 5% interest for the year. So at the end of then year two, she'd have that $1,000 with 5% interest, so $1,050. And then she would get another $1,000 credit at the end of year two. So her new balance would be $2,050. And then it just kind of keeps
Keep going. Yeah.
in that way. So it's very similar to a 401k in nature, right? In that it's an account balance. And especially if you use a market rate of return as your interest crediting rate, it can really mimic a 401k plan, with the exception of the benefit credits that are awarded to participants. They can never get less than that. So you can't really lose money. So if it's a bunch of years of negative returns in a row, that's not great, right? But we don't see that very often. And eventually, the markets pick up and everything kind of gets back to the amount, right? So in that sense, it's very similar. The big difference between the two, administration of a cash balance plan is actually simpler than a 401k plan. The actuary for the plan would handle almost all of the heavy lifting. The client has very little to do. The plan sponsor has very little to do. The other difference is the contributions are mandatory. So, there's limits to them, of course, that are much higher, which I think we're going to get into here in a minute, right, Bonnie?
Right. Let's talk about that in a minute.
Yeah, let me just jump right into that, right? You were kind of saying, what are the limits for a cash balance plan? Well, so you've got the DC limits. The deferral limits are what, $30,000 approximately, with catch up.
7,005. Yep.
Yeah, with catch up. Add a profit sharing piece, maybe you get up to about $76,000 with catch up. I think it's like $69,000 for 2024 were the limits. Well, a cash balance plan limit, let's take somebody who's 60 years old, because typically these plans are a little better for older business owners.
It's age-based, right?
Yeah, it is. It's age-based, and a lot of the business owners, they've tied up wealth in the business early, maybe if they've started
And
their
they
own
need to
business.
catch up.
Yeah.
Yeah.
So you got up to $300,000, 320, $330,000
For 60
for
years old.
60 plus. Yeah.
Yeah.
Um,
So it's like 34 times
yeah,
what you normally can get from 401k. Yeah.
yes.
Even if assuming you max out.
Of course, and you don't have to max out, right? So you don't have to contribute $300,000 if your income doesn't allow for it,
Right,
or if you
right,
choose
right.
not to. Even for a 30 or 40-year-old, these limits are well over $100,000, which is a big difference, from the $69,000, DC limit.
But the company pays for everybody's contribution.
Yes,
So that's it.
mostly. So I will say that there are arrangements that you can have in partnerships, which we work with a lot of law firms that do this, where essentially the partner makes their own cash balance contribution. Especially if they have, their own, if they have their own little like PC. There's opportunities there where, yes, technically it is coming from the firm, but if you have certain agreements with participants or with partners, you can work it out so it's paid for by so the contributions are essentially paid for by the partner.
So on a partnership, you can do that. But if it's a normal S
If
corp,
it's
a
a
single, you
normal
can't.
S
Yeah,
corp, yes, the owner
the
is
company
on
has
the
to pay for
hook. The
everything.
sole owner is on the hook for the benefits for the participants. Now, the nice thing there is oftentimes, we can design these plans so the benefits for the owners are significantly
Definitely
larger.
more.
Yes, significantly larger. And
How
so,
about
don't see these numbers and think you have to provide $300,000 to a 60-year-old employee,
what
right?
about good question? Like, so the minimum that you had to provide in order to get the cash balance plan running for the owners to maximize how much you had to pay the rest of the
So,
employees? What
so that
percent?
totally depends on the demographics
Mhm.
of the workforce. So the older the workforce, usually the more you have to give. And the reason that is, and then obviously the inverse of that is true, right? The younger the employees, the less you need to give. The reason for that is that we have to do what's called non-discrimination testing. And a lot of times when we do the non-discrimination testing, the testing is combined with the DC plan as well. So those benefits are kind of incorporated, which can help us pass testing. But again, the younger people have so much longer to earn this money. So for them, it's just you just have to give them less of a benefit to order
So age
to be
base.
non-discriminatory, right? So the older the workforce, the older the population, the older the demographics of the population, the more you have to give, but it's still, and then of course it depends on how much the owner or owners themselves want to sock away and save. So this is something that you would work with an actuary on.
It's complicated.
And yeah, it is. It sounds more complicated than it really is. We've got really great tools to design these plans, to kind of come up with what we call illustrations. And we provide illustrations at no cost. We just need data. We don't even need, identifying information. It's very simple census information, and we can put together an illustration with a couple of options and a couple of designs.
Let's say, like, so if I want to max out, okay, let's say, I don't know, I get 300,000, whatever. So normally do I have to give like at least 3% to my employees? This is on top of whatever I need to match to
Sure.
3% to
So
5%,
yes,
say?
yes, that can also depend, right? So it could be up to as high as 7.5.
Mhm.
It just depends on, I don't want to get too into the weeds here with the rules,
Right. But
but
I want to know how much I need to pay in,
yeah, it'd be 5 to 7.5%.
5 to 7.5%, but it's not 100% invested right away.
No, no.
So the 5% to 7% also can have a 5 year or even 6 year vesting
So
schedule when you do.
unfortunately, with cash balance plans, because they're considered a hybrid plan, they are subject to a little bit quicker vesting. In order to avoid a lot of issues, we typically see either immediate, that's a lot of times with these partner plans and that sort of thing. Smaller plans, where it's an owner and maybe 4 or 5 employees, or
Employees,
like 30 employees. We, a lot of times though, we use 3-year cliff vesting, which means they're 100%
3 year.
vested after 3 years.
So nothing until 3, and then you get
Yes.
100%. Well, if
Yes.
you don't stay, well, that's actually not bad. Yeah.
Yeah, because that way you don't have people coming and going just, in a year and a
Yeah.
half and
And then
just,
you still have to calculate, okay, so you don't stay for 3 years and you're not you haven't shown your commitment, so you're not going to get anything.
Exactly. And then the nice thing is if somebody does leave after those 3 years, that money does stay in the plan because you had to contribute for them. And that can just then kind of offset future contributions to other employees. So, those are tax deductible contributions, so you don't love that happening too often. But yeah.
So after they leave, you don't have to contribute anymore, right?
No, not for them. No. But
Yeah.
for other employees, right? So like if you owed another $100,000 for them, but it's sort of like a forfeiture account in a DC plan,
I see.
right?
But yours is like 100% vesting, in 3 years it gets zero. Oh, but you
Right.
put the money in. I
Yes,
see.
you've
So you
already
use the
contributed
money
because you have to contribute that money each year, right?
anyway. Yeah,
Yes.
right.
So
So
very similar to a forfeiture account,
mhm.
in a DC plan that, has vesting as
You can
well,
use it for something
or
else.
match.
Yeah, for future. Yeah, That's pretty good. Yeah. So like how big would you say normally this type of plan, like 10 employees, 20, what would be otherwise if it's
Oh,
expensive, what would you say?
so I have worked on plans. I've worked on sole proprietors, so just one, and we go up to thousands. Um, so literally it can, yeah, it can be any size.
My
Um,
heart is like jumping up and down.
I would say though, our typical, the bulk of the plan, so right, like our smaller business, I would say under 100 total.
Even 100 is a lot of money because it's 5 to 7%, you said, right? A
Yeah,
half
it can be
percent.
it
That's
can be
still,
big. But
yeah.
we have even more plans, that are 5, 10 people or less, right? That's probably the most common.
Yeah, I
Um,
think so. Yeah.
Yeah,
And then those are like probably like what you said, if it's like a professional company, most of them are like co-owners anyway, so they don't mind, they want to
exactly.
get for
They're
themselves.
all they're all getting these deferral opportunities. That's what they
Yeah.
want.
So
Yeah.
it's a good. So those probably will be the most like likely candidates who would think about cash balance plans because they're professional, so they probably make nice money. And of course, they want to save more and avoid more taxes. So this is like a great tool instead of just 401k. But then you can only get a
And
maximum 70. This is like depends on your age, like a lot, 2, 3 times more. So
yes,
that's very nice.
one other thing I just want to point out is that one key to this is you really want the potential, owner or plan sponsor to have consistently high income. Um, I've
Oh
worked,
yes.
for example, I've worked with like a real estate agent, who had a
I see.
plan.
I see.
And, so one year she'll make, well, I'm just making up numbers here, right? $1.3 million. And then the next year she makes, $250,000.
Uh-huh.
And, that can be tricky because it can really drive the amount of, like, you might have bigger contributions than you want in those years where you have less income.
Mm-hmm.
So really, we do recommend this to
More
fit
stable.
best when
Mhm.
you have consistent income,
Yeah, makes
right?
sense. Makes
Yeah,
sense. Yeah. Otherwise, where's the cash flow?
exactly. Yeah, because you have to put this money in every year, right?
Yeah, and then I'm
So
not making so much anymore.
yeah, it can be. It's been a pain point for some
Yeah,
of those types of clients. So we really do, try to get ahead of that, and people still do it anyway, and that's fine. But you just want them to be aware because the
yeah,
worst part is the surprise, right?
yeah.
Like,
You
oh,
need to make sure you have the cash flow.
yeah, you don't want bad surprises for.
And you're not supposed to. I see somewhere that you cannot just turn it on, turn it off. I have this plan, get my savings in 1 year, the next year I shut it down.
Right.
Can't do
So
that.
there is kind of like a permanency rule that the IRS has. The weird thing about this is that the IRS has never come out and said what constitutes permanency. We have found, in, obviously decades of experience with these plans, that typically 5 to 7 years is safe.
Hmm.
7 years is very safe. We
Hmm.
haven't seen very many issues at 5. And then, of course, if there is a legitimate business reason to terminate the plan sooner than that, that is also acceptable.
Or the
It's
owner
just
passed away,
it
so
can't
what are
just
you
be,
gonna do?
yeah, if the owner passes away, no problem, right? But
Right.
it can't just be like, I don't want to pay for this anymore after 2 years, right?
Uh-huh.
Because then
It
it's
may not
like,
be one time. You just want to take advantage of it, not paying
yes,
taxes, so you can't do that.
exactly.
I get it. I
And
get it.
again, you might be able to get away with it, right? You might find an actuary who'll do that for you. You might try it, but the IRS could certainly come calling, and I wouldn't. And then you'll just
Full
owe
advice.
back
Yeah.
taxes.
No. Yeah.
It's
Mhm.
just not worth the hassle.
Yep. I
Right?
agree. I agree. Well, this is a great information. So, if I want to start a plan, what kind of information would you need from me?
Good question. Thank you, Bonnie. That's a great question. Realistically, all we would need is the census information for the workforce, basically
So
everybody employed. We would just need date of hire, date of birth, and gender.
you
And
need
then
the work, whatever the title, so you
yes,
categorize them. Do you do?
yes.
Yeah. Mhm.
So titles, if you want to break them out by groups, and then compensation. Typically, we would ask for sort of box, I think it's what, box 5 on the W-2, so gross
What is it? I don't know.
compensation. And then, so it's gross, it's gotta be, it has to be 415 count for testing purposes. And then, of course, the compensation for the benefit can be, that's determined by the plan sponsor and in conjunction with the actuary. So that could be base pay, that could be, budgeted comp, that could be, actual W-2 pay. There's a few options there.
OT, bonus.
Yes. Yeah, exactly. It's kind of like what you want to include, what you don't.
So it all depends.
But yeah, and that's still, yeah, and usually you don't include that kind of stuff just because it's simpler, right?
Mhm,
But
mhm. Base pay,
um,
base pay.
yeah, but so base pay and then W-2 comp for testing purposes, date of birth, date of hire,
Uh-huh.
gender, and then like you
Uh-huh.
said, job class, job
Has
code.
to be full-time employees or part-time count too?
It could. So send the part-time, provide the part-time, the actuary can handle,
Okay.
handle
Wow,
this.
even part-times can count. Well,
They most likely won't.
uh-huh.
But sometimes if depending on the
Might.
demographics of the workforce, it might be advantageous to include them.
I see. Yeah.
If they're
Okay, to pass the
young
test,
and
right?
yeah. It's just give us everything and we'll do our magic, right?
Interesting, interesting. That's why we need you. It's very complicated. Yeah.
Yeah, but that's the nice thing is we will present it in a manner that is not complicated, and all of the complicated parts you don't have to worry. The plan sponsor, the owners, they don't have to deal with it, right? That's all on the actuary. They'll do the design, they'll do the administration, they'll handle the 5,500. We handle all of that. It's really just, hey, let's talk data, let's
How
talk
much does it
strategy.
cost? Is it expensive?
Well, I don't want to define expensive for folks, but it can be, a very simple plan, for let's say owner only or just a couple of employees.
Mhm,
It will cost, a couple $1,000
mhm, mhm.
annually for the work and the time. But if
Even
you're
for 1K costs a couple $1,000, like a minimum
exactly,
charge of 1 or
ex-
2,000 at least, and then per employee, depending how many, right? Could be $2,
right.
$3,000 easy.
Yeah, yes. So yeah, it's well worth the investment for the tax
And you
deductibility
can
of the
deduct that
contribution.
as well.
Yes, yes. The fees can be paid from the trust. So
Mhm.
yes, that can be, those can be
Does
deducted.
it count towards like Secure Act 2.0? Like, can you deduct it? Is it like a legitimate qualified plan for if I
Oh, yeah.
start? Ah,
Yes.
okay, so up to $5,000 for 3 years, right?
No, not in that sense for Secure 2.0.
Oh,
Sorry.
I
No,
see.
no. But yeah, it's though a lot of Secure 2.0 obviously has impacted cash balance plans, but yeah, no. It's not for that.
But anyway, the expenses are
Yeah, they
eligible
can, so
deduction.
the expenses can be paid from the trust of the
The trust.
plan. All the contributions to the trust are tax deductible. So, what we kind of do is if expenses are paid from the trust, those just kind of get tacked on to the required contribution, not quite one-to-one
Ah,
with
I
that. But
see. I see.
similarly,
I
that's
see.
kind of the rules around that,
I
just to make
see.
sure that you're not paying expenses out of the funding for the benefits of the employees.
Mhm,
But,
mhm.
yeah.
Well, I think that's a lot of great information. Is there anything else you want to share?
You know, I will just give one plug for market return cash balance versus what is called fixed rate cash balance plans. The fixed rate versus the market rate of return is the rate that is set, that the participants earn, their interest crediting rate that they earn. Market rate of return cash balance plans, like I said earlier, they track much closer, much more similarly to actual 401k plans and account balances. And there is significantly less volatility in the contribution levels for market return cash balance plans. Whereas fixed rate plans can have wild fluctuations if there are wild fluctuations in the market. year to year, which, over the last decade, we've seen
What if
that
it's
number.
negative? Do you get
Yeah,
money?
if it drops, you got to, if that goes negative, you have a massive contribution, right? And then if you earn 20% one year, your contribution shrinks, it can shrink really small. And if you're banking on that tax deduction and now your required contribution is 50% of what you were expecting it to be, that's not a fun
That's
story
not
to.
good. So normally people do like a fixed rate then. Market is too much calculation.
Yeah, but it is more calculation, but it's so much better for the plan sponsor.
So
So
you
the
get more money if you do market.
Well, so the lifetime limits are the same. So you don't get more money, but
Ah, I
you get
see.
you get a more consistent amount. So, you still get, so the lifetime limits on a DB plan are approximately $3.6 million.
Hmm.
I didn't get to mention that earlier. We were talking about annual
3.6.
limits.
That's quite a lot.
Okay.
3.6,
But
yeah.
the lifetime limit is, close to around $3.6 million. And so that doesn't change based on the type of plan you have, but the path to getting there on a fixed rate plan can sometimes be 2 steps forward, 1 step back, sort of movement. Whereas on a market rate of return cash balance plan, it's just sort of a natural, just kind of head up the stairs and you'll get there.
Let me clarify. So I thought fixed rate, let's say 5% every year you pay into the plan 5%.
So no. So that's the interest that is credited to the benefit credits that you give. So let's say, let's go back to my first example. So the benefit credit is like, let's say it's $1,000 for a regular employee,
Mm,
right? The
mhm.
owner can, let's say the owner's taking 100,000,
I
but
see.
he's giving $1,000 to each employee. So they
Mhm.
earn 1,000, and then the interest credit is what happens between those in the interim. So if you use a 5%, you have to give 5% interest on all the benefits. But if the market is down 18% for the year,
Mhm.
like 2020,
Mhm.
right? You still have to give 5% to everybody. So that,
Mhm.
that contribution size can get massive,
Right,
right?
right, right, right.
And if the market is up 20% or 15%
You
for the
still do
year,
5%.
and you only promised 5 to everybody, well, now your assets did really well, and now you don't have to contribute as
Pay,
much money,
yes.
which
Mhm.
means you're not making as big of a
I
tax
see
deductible
what you mean.
contribution.
So it just goes up and down. You don't have to worry about it. If you do market, it goes up, you get market, it goes down.
Yes,
Sorry,
the
it's still
balances
market.
just
You don't do
move.
anything.
It
Yeah.
doesn't impact your actual
You don't have to,
contribution.
I see, you don't have to make it happen because that's what the
Yes,
market is. If
yes.
if it's a fixed rate, it's 5%, the market is 10%, then you have to put another 5 there. Mhm.
No. So actually, you'd probably put less because your assets would
Oh,
earn
yes, yes, yes,
10,
yes. You're right.
but
Yeah,
you
you're
were
right.
only
Yep.
crediting
Yep.
5.
Yep.
Yes.
Yep. 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 Well, you can't you're not taking money out. It's just that future you put less in, right?
Correct.
Okay.
Correct.
Say thank you for
And
clarifying.
then because the more it earns that you're not giving to as it benefits, the less deductibility you have in the future.
That's true too. That's true too.
And
Yeah.
then one other point I wanted to make, which I think is actually a pretty big one, for some of these older owners. So typically, cash balance plans, especially a market rate of return plan, I mean, even a fixed rate plan, they're typically invested. One other big difference between them and a 401k plan is that the assets are pooled in one account. So
I
individuals don't have control over what isn't what,
They don't need
investment
to,
they have.
that's why it's easier
Yes,
because it's one pool. So you just
yes,
invest that money, one pool of money. And
yes.
it's either tied into the market or whatever the fixed rate.
Bonds, yeah,
Very
yes, or
simple.
you can go into, yes. And then the other thing with that, this is a big advantage for owners. So now with secure and the recent changes to the rules, they're allowed what they're called in-service distributions starting at age 59 and a half. So once a participant who is not is actively employed, and they can start taking distributions at 59 and a half from the plan. So
Mm.
what that means is typically the plan assets are invested a little more conservatively, right? Because you don't, maybe
You want
more
to make sure
like
the money's
more
there.
conservatively than a personal account, right? It can
Right,
be a little riskier when it's just your money if you're
right, right,
investing
right,
it
right,
for a
right.
bunch of people. So what somebody who's 59 and a half or older can do is let's say let's say it's an owner who earns $100,000 on December 31st, right? They can put that money in the cash balance plans account on January 1st.
Mm.
And then again, on January 1st, they can take an in-service distribution of
Yes.
$100,000 and
Uh-huh.
roll that over into
Do
their
something else.
401k, into an IRA.
So you can invest any way you want.
Yes.
Right. But
So
then you have the maximum amount to put in, otherwise you can't do that, right?
yes, yes, you had it's a
Got it.
lot more, tax
Flexibility. Yeah, it's
advantage
very smart.
money.
Particularly, I'm a little bit older, more than 59 and a half, then hey, just do it because I can put a lot more in. Then I
Yes,
decide
put it
to
in,
put
get
in
the
whatever I can.
deduction for it, and then take it right out and invest it
Yes.
however you want to
Yes,
invest it.
yes, yes, yes. To maximize my deductions. That's a great, yeah. That's something that we should share with people. I don't think they
That's why I
understand.
wanted to make sure that was one of the
Yes,
things I
it's a
wanted to get
good
across
one.
because people don't know that. Owners think, oh, it's going to
Oh,
sit in there and it's only going to earn, it'll be
whatever, yeah, 5%, 4%. No,
a
they get more
typical,
flexibility.
even in a market return cash balance plan, a typical portfolio is 60-40, 50
Oh, I see.
sixty
So more
forty
like a
equity bonds.
balance, more like a
So
balance plan.
yeah, so they can take it out and they can go 90-10, whatever
Oh, I
they're,
want to buy real estate.
yeah, yes. I mean, the only thing there is if they take it out, it could there could be some tax, they'd have to pay
There'll be some
taxes.
taxes. That's true. Yeah.
But still, they'd get the tax deductibility. They could, depend. That's something that we don't get into because
They
we
can
leave that
play it
to the
out
accountants
with
and
tax
the
return
tax
to figure
advisors.
out.
Yeah,
Yeah.
yeah, of
Well, thank you so much. I think this is great. A
course.
lot of learning, a lot of information. How do we get in touch with you? We want to get your help.
Yes. Like I said, so I work for October 3. You can go to www.october3.com. That's a good way to just reach out to anybody
It's an
there.
easy one to remember too.
Yeah,
October.
right. October 3. Yeah. Super easy. Again, my name is Ricky Atamian. You can find me on there. My email is on there. It's first initial, last name at october3.com. Happy to answer any questions, put you in touch with anybody that, with any questions you have. We've got a lot of experts on all things retirement. So please feel free to reach out
Yeah.
and happy to help.
Fantastic. Yeah. Well, thank you so much for all that great information, and thank you for attending today's podcast. If anybody wants additional information, can reach out to me or directly to October 3. We're happy to help. And please leave us your comments and let's grow and get inspired. Until next time, thank you very much. Thank you for attending this podcast.